Couple of things before we start today. First, this session will be recorded. And second, if you could please hold your questions till the end of the presentation and either raise your hand or enter it in the chat box, and we'll get to you your questions in the order they appear. John, whenever you're ready.
Sure. Thank you so much, Ian. And also welcome to everyone. Great to see you here this morning, or at least your names on the side of my screen. It's a real privilege to have this November webinar speaker being Jesse Cole. As you know, we try to sort of have different topics that are of interest to the conservation and environment and agriculture community across Canada each month. And I know the topic of insurance and conservation and insurance has been one that's been raised a lot over the last couple of years. And so we're really pleased that Jesse Cole can be here this morning. Jesse Cole is from Clive, Alberta, and he works for AFSC, and he's the manager, I believe, of something programs and innovation. And I'll let him elaborate a little more, but Jesse and I went to graduate school together, so we have a long history and friendship. He's a bit of a character, which is always nice to have it a presenter. And I'm really looking forward to hearing what he has to say this morning. And yeah, all of you, have some questions and pose them to him at the end. I think it'll be a good conversation. All right. Thank you. Jesse, take it away.
Thanks, John. Don't hold it against John that we went to school together. That's in no way a reflection on his character. So yeah, I'm Jesse Cole. I manage the insurance products and product innovation area at AFSC. Our headquarters is in Lacombe in Alberta. It's kind of in between Edmonton and Calgary, if you're not familiar with the province, and that's where the headquarters is for the provincial delivery agent for crop insurance here. I'll get into it, but every province has a delivery agent in one way, shape, or form, other than the territories. So my team does basically market research and product design for insurance products in the crop insurance realm. We're not part of like the private insurance system where you have to be licensed and follow the act and regulations. We're under a separate separate permissions to exist, I suppose you could say, more political delivery agent. So without further ado here, I'll get into it. And everybody can see the screen. Good to go. Awesome.
Yep, looks good.
So yeah, so I think you have the right person if you want to talk about insurance. I get very excited about insurance. Most people don't. It's not really an exciting topic unless you're really into it like I am. So really want to get into discussion. I think it's more about that than this loose outline here. But I'll go through what, kind of what is AFSC and agri insurance? Like, what are we talking about there? Insurance and conservation, how do they fit together? What's the philosophy, I guess, from AFSC at this point in time? How are we thinking about it? Are we thinking about it? Current conservation, environmentally related initiatives, what are we currently doing? And where are we headed in that direction? In line with what some of the political elements are and where our heads are at and who we are as an organization. So I think the discussion will be really good. I think I'll have more questions probably than answers at the end of it, which is, I don't know if that's a good or a bad sign. And so we'll get into, some of the history is important, I think, because we're an institution that's existed in Alberta for quite a while. And if you're from another province, a lot of the other provinces are fairly similar, especially Saskatchewan and Manitoba. BC is a little different. They have their own, exist out of the ministries. So some of them are combined with the ministries. Some of them are crown corporations. They all deliver crop insurance in some way, shape, or form, depending on what crops are in that jurisdiction. So before 1905 came along, before Alberta was a province, after the treaties were signed, all these institutions started popping up, and hail's a big issue. Hail's huge in our province in terms of destroying crops. So not as big in some other provinces, but in Alberta, probably just about half of the indemnities that we have in the insurance side are caused by hail. Basically, the other half is drought. So those are the two big ones. But so the territory sold hail insurance, wasn't cost shared. I'll use the term cost sharing quite a bit. And it just means subsidized. So premiums are cost shared or subsidized by currently by the provincial and federal governments. Back before 1905, they weren't subsidized. It just came out as a product that you could get to cover your hail damage. 1912, some private companies started jumping into that market, wanted a piece of it. A lot of them are still here in one shape or form or another. So they've existed for quite a few years, more than 100 at this point, which seems like a long time in this country, but might not be in something like Europe, where you see the first crop insurance programs jumping up in 1820 kind of time frame after the Benjamin Franklin years. I think he was probably credited with the first real thoughts on crop insurance. Oh, Roland's here. Awesome. Good to see you, Roland. So we got Roland and I share a similar background. And yeah, so hey, how's it go? Your name came up today. So 1912. So they're in the market here, operating with varying degrees of success. They don't cover all of the territory, like they're not covering all the people. They have quotas on liability. So there's some issues with equity, I think, across the board with them. So the provincial government in 1938 created the Alberta Hail Insurance Board. That's where this William Aberhart guy comes in with the Social Credit Party, and the ag minister at the time, D.B. Mullen. I've put a picture of them so you can kind of visualize them talking about it at the time and pondering on whether they should create this hail insurance board. That's the genesis of AFSC. It's kind of where we started. 1964, the Alberta Crop Insurance Corporation is formed after a few years. I'm sure somebody said, we have this hail insurance, it's great. What about drought? What about some of the other stuff that's happening here? We're losing crops to non-hail related perils. So the first time that an all-risk crop insurance was seen in Alberta was 1965, and it covered wheat, oats, barley, only at the 60% coverage level. Now we have 80%, generally speaking, across the board. In 30 townships, Vulcan, Lacombe, Vermilion, and from there we get the evolution of these products to kind of where they are today. Going through 2001, where they first hit $1 billion in liability, and we're at about $10 billion today. So big expansion, kind of different periods there along the way. We've got the Shirley McClellan years, we've got the Aberhart years, we've got different eras of political influence as well. So very interesting things going on in the background. 1979 was the first time that hay and pasture showed up. So on kind of that livestock focused side of life. That was a model-based approach for that program. And again, kind of the evolution out of that is what we see today. And in 1993 is when the Alberta Ag Development Corporation merged with the AHCIC, the Alberta Hail and Crop Insurance Corporation, to form AFSC. That's kind of where we come from. So older than any of us on the call, hopefully. I think. Anybody out there? There's probably a prize somewhere if you're older than 1938. That's the year my dad was born. It's a miracle every time I see that guy. He's 86. So we're a provincial crown corporation. Kind of where are we today? We're a delivery agent for business risk management programs.
Oh my God.
And again, all provinces have some shape or form of this delivery. And the BRM programs are funded through agreements that get negotiated every 5 years. So the current one we're in is the Sustainable Canadian Agriculture Partnership that came right after the Canadian Agriculture Partnership. The Sustainable was added on in this iteration. That one was after the Growing Forward agreements. So we're a few agreements in this framework type setup for funding. Before that, there was various funding setups where, it was half and half or 60-40 or different levels of funding from federal and provincial governments, but we're in a fairly stable epoch, I would say, right now with the 5-year funding agreements. Ask me that in 5 years. So we have 38 branches from Medicine Hat to La Creek across the province. Each one of those branches has anywhere between 2 and 20 people in it. Lacombe's got a few more kind of spread across remote work now. People on my team are anywhere from Airdrie to Barrhead, Cremona, I guess. There's somebody in Cremona. One of the folks even works in Saskatchewan sometimes because he farms there. Yeah, so what are we talking about when we talk about business risk management? There's 4 big parts to that. Some may be familiar with the BRM suite. that is funded through the funding agreements. Agri-stability is one of the pillars, and it's a financial stabilization program that covers margin declines and is meant for more catastrophic events. So kind of that 1 in 15-year event it's supposed to cover. And when it really gets bad, agri-stability is supposed to be there. Agri-insurance is more rich, I would call it, on the high side. Covers more, probably more like a 1 in 5 to 1 in 15-year event. We would want to cover. Anything less than a 1 in 5-year event would be called normal risk by both the province and the federal government, and something that we wouldn't want to cover because it's happening potentially in an average year. So not a really high probability catastrophe. Agri-invest covers gaps. It's a bank account basically that somebody puts in, a farmer would put in 1% of their allowable net sales, they call it, up to $1 million. That's the cap on that. So up to $10,000 goes into an account. The government matches that, and you can pull it out for any reason, theoretically to cover some type of risk or loss that was incurred by some type of natural peril. They get used for, there's no stipulations, so let your mind wander there. Agri recovery is there, and so that one's kind of meant to cover anything that's not covered in the suite. Something that happens in an ad hoc fashion where there's no cost shared insurance product for, and some type of extraordinary cost. So the most recent one was for livestock producers. Our livestock products aren't, in our perennial insurance side, aren't super well subscribed. So the question comes up, do we actually have a good program there? Do we need some coverage for that? Do we need to cover feed? Do we need to cover some of these things that happen in a drought, which would happen above and beyond what a crop insurance producer would experience because crop insurance is very well subscribed. So that those type of questions get asked in the agri recoveries come up, and they're very political. Things that we do that aren't really in the suites, lending. Some provinces have lending, Manitoba does, and we do, Saskatchewan doesn't. That's kind of outside of the funding agreements and the BRM framework. Straight hail insurance isn't cost shared, but we offer it. It's kind of the same thing that the private companies offer. We compete in that market as well. I think a lot of those companies wait until our rates come out and they use our rates, and there's adjusting back and forth, and usually meant as a top up to the hail endorsement if somebody's an AFSC client. But it provides an option if you don't want to have crop insurance, but you want to have hail insurance. So you don't want to have that drought, gopher type insurance. LPI, livestock price insurance, is basically a put option on cattle and hog prices, and isn't cost shared. So not in the suite. It has its own multilateral agreement. Wildlife damage compensation is more of a statutory program that Alberta can offer and does. So we administer, if an elk is running through your barley and eats a whole bunch of it, usually it's a whole herd of them, and causes significant damage, we compensate for that. There's no premium related with that either. So I'll just go through the insurance products quick here. They're stratified generally into annual and perennial, and this matters later when we start getting into land use. But on the annual side, we have the flagship is multi-peril crop insurance. Big program, covers roughly 17 million acres in the province across probably 10,000 producers. Processing veggies, NCII, corn heat units, insurance, honey and bee overwintering products exist. Silage and green feed insurance, although that's, I'll circle these later. Perennial, we have pasture insurance, which is a moisture deficiency insurance product. It's based on weather stations. We have hay insurance. It's a production product. Very low subscription on the hay insurance. That's why it's red. The blue ones are kind of the flagship on each side. The red one, I don't know if that's red or not because I'm kind of colorblind, so you might have to help me. Export Timothy's there too on the perennial side. And then I've got some other stuff that defies categorization a little bit, like perennial grass seed. That's an annual crop insurance product, but is a perennial. Straight hail, not cost shared, goes across. You can get that on hay, as well as a lot of annual crops. And LPI, of course, it's a very interesting product. I think it's one of our best ones. There's no cost sharing. but it's a very interesting design using kind of a Black-Scholes model in the background to create premiums. So here, kind of circled these like a 5-year-old with a crayon, are kind of what I would call in the crop insurance, like annual crop insurance type um, grain and oilseed products, even though straight hail you can get on hay. And then I would call these ones, well, including the straight hail, I guess it exists in both places, but like the LPI, the perennial insurances and the silage green feed are more focused on livestock production. And these don't include, like we have endorsements and benefits that are included and options sometimes with these products. The hail endorsement is an option, and the variable price benefit is included with a lot of things, including MDI for pastures. So that'll pay out, this year we paid out 156 million in MDI across the province, and the VPB is going to kick in and pay out an additional 22% of that. So what's that, another 32 million, somewhere in there. So they're big products. Like hail endorsement is larger than a lot of the other products combined. Like if you take multi-peril crop out of there, it's a huge amount of premium and indemnity every year. 90% of our annual multi-peril crop insurance clients take the hail endorsement. It's cost shared as well, so for that peril, it's quite inexpensive. All right, so the perils, what we're talking about when we say peril is something that causes some kind of damage. And where we focus is non-management related, natural and fortuitous events. So something you didn't cause that happened to you. Tornadoes and wind and drought and hail. Hail and drought are the two biggest ones. In the last 20 years, to give you an example, drought is 57% of the indemnities, and hail's almost half. So the rest of them are, pretty small, like 3, 4, 5% type numbers. I think on the rest of these. Wildfires covered, so if you see wildfire stuff happening, farms on the edge of a fire, it'll be covered in some way, shape, or form. Pasture as well. So it depends on the product, what's covered. Honey bee overwintering is a little bit different because bees kind of respond to different perils a little differently than crops do. So that's kind of crop insurance in a nutshell. We skimmed over that really quick, so hoping there's some questions about that too. But conservation, what are we talking about here in our context? I Googled it because I'm not a real conservation brain. I know John and I went to school together, and I met this guy, and he was really passionate about conserving wetlands and species and biodiversity, and I couldn't spell it. I don't think my work focused a little bit on winter wheat breeding programs and whether farms are willing to pay for increases in migratory waterfowl nesting success. You can probably answer that one without doing all the work, just intuitively. In some ways that people are willing to do that if there's a financial motivator, but exclusively for the ducks, no. So that's kind of where I'm coming from. It's a very interesting topic to me, and I think, Googling it, this is the Merriam-Webster version here, careful preservation and protection of something. So that's kind of what I'm working on. And from that, I looked at, okay, so where are we coming from? Like if we're going back to 1905, going back to 1820 maybe, or 1850, and looking at the landscape of this country before institutions got here and settlers got here and kind of plowed everything up and made it the way it is today. So we're working in this framework today, kind of accepting that conservation isn't going back to that day and age, at least not yet. We're not turning everything in Alberta back to native grassland, potentially. But we're looking at, okay, what do we do within that framework to try and conserve things? How do we use the dollars and the effort that we have to conserve stuff, and where do we look at? So in the crop insurance world, I think we're looking at land use. So these land use changes, what are we doing? How are we affecting incentives, market distortion, I guess we might call it? How is that subsidized element, that cost shared element of premium, and how are the differences in that premium across different products affecting land use and land use change? So are we incentivizing somebody, for instance, to take pasture land and turn it into annual cropland? Is that us? Is that something else? Are we contributing to that? And how do we think about that? So I don't know if native and tame pasture matters in this context. It's, in my mind, kind of, on the margins where we have land that probably should be used for pasture and gets put into canola because the price of canola is high and the stability is there with some crop insurance. So we'll get into that, but there's other things that are going on. Like I think there's stuff that we see, like forested areas being cleared for farmland. A good example is the Crete. There's lots of land up there that gets cleared, and we see a lot of organic land coming out of that because it's easy to get certified. We have organic insurance, so we insure it. And farmland turning into cities. I'm not sure what to do there. That's an interesting problem. And conservation within the type of production system. So how are we conserving what's already there in that land use in terms of habitat and marginal land? And Hurricane Katrina is a good example in my mind, is all these mangroves that were taken out to put a big shipping lane in and may have affected the natural state of preventing some of the disaster that happened there. So what are the consequences too, might be a good question. So what does insurance do there? And what does it do in general? We know, and most people on the call, I think, will know a little bit about insurance through car insurance and home insurance and any kind of life insurance if you have it. And in terms of stabilizing volatility. So we're trying to get rid of a risk that's causing some type of volatility. In our case, it's revenue for farms. So how are we stabilizing year over year volatility to keep that revenue stable year to year so that we're increasing the long-term financial stability of farms? The private side, in terms of for-profit insurance, they're transferring that risk at the correct cost for that risk, plus a profit load or some type of premium on top that makes them money. In our instance, in terms of government-funded insurance, we still stabilize the revenue, but we transfer the risk for less than the premium cost. So we're not, there's not really great information on what somebody's willing to pay at different levels. We kind of influence that demand curve quite a bit. And a few studies out there about when that starts to happen. So what level of cost sharing influences somebody to start taking more insurance? How does that participation curve react to it? It kind of starts changing in a significant way according to some of this work at about 30%, 25, 30% levels, and accelerates as we get closer to 50 or 60%. Generally speaking, in Canada right now, the cost sharing, what the federal government would call high cost contribution levels, is a 60-40 government producer split, and the 60% is 60-40 federal provincial. So the federal government's paying 36% of the premium, the provincial government's paying 24%, and the producer is on the hook for about 40% of the premium. In most programs, that changes. The federal government does not like hail insurance, and I get that. It's very rich, covers people at a very high level, and they pay, I think, about 11%-ish on that one. So it's almost a 50-50 producer government split. Anyway, so that's kind of where that's coming from. It effectively raises expected return on the commodity for the producer as well, especially if it's cost shared. So we get a little bit of the band that is, I guess, representative of the saving between the private and the cost shared insurance, and potentially lower input costs that drive expectations on output prices as well. So if you're spending less money to make the same amount of revenue and it's more stable, potentially you'll accept less, especially in cases, I think, where markets are more domestic. where that matters, where you're not exposed to systemic global prices, like wheat would be a more systemic global price. Hay might be a more domestic, barley might be more domestic, especially in the feed market. So differences there, I think, unless globally everybody's subsidizing insurance. So then it's all part of the same giant system and there's little differences, but what does Kazakhstan do if they're not subsidizing insurance? They're kind of in a different position than us and just a whole bunch of stuff going on in there. So we'll keep it Canadian for now. So I've made up some numbers and this is just me writing stuff down, going, okay, what is this going to look like? Tried to keep it as representative as possible here. The $42 an acre premium is actually what the premium is per acre for annual crop insurance in Alberta for 2024. So I've thrown in some revenue numbers, some expense numbers. I'm assuming that expenses are about 70% of average revenue. Not the case all the time, but for illustration purposes, just throwing these numbers in here to show a margin and what insurance does to the margin. So the blue line is without insurance. So you can see that margin dipping between positive and negative. It's going negative in poor years where somebody has put out a whole bunch of money for fertilizer and chem and seed and other inputs, and all of a sudden they don't have a crop. Well, geez, there you go. Now you still got to pay the bills. Probably missing some interest on loans that somebody took out to actually pay those bills, which we also offer people if they need it. It's another thing. But yeah, so that blue line is kind of where you're at without insurance. And the two other lines, again, colorblind. I don't know if you can see them really well. The red one, the lower one of the two that are left is the private insurance. Is it red?
It's red.
Oh, perfect. And the other one's green? Orange? Okay, whatever color that other one is, that's us. I've just put in 80% coverage level because that's the maximum you can get. So that's showing the most potential distortion there. And yeah, so you kind of see, so we're raising the line basically. So you're still cutting that bottom end off and you're getting more at the top end than you would with a private company. So, it's a better situation. This average annual margin calculation, I threw that in there just to look at. I've got it a bit wrong here because theoretically, private insurance should give you a lower expected return on average. Private insurance companies know exactly what they're doing and they can figure out what that line looks like and kind of charge amounts that make sense there. So I've kind of screwed that up. But in general, it's pretty correct. With the 80% coverage with AFSC, like our kind of crop insurance setup, your expected return or that average annual margin is going to be higher than it is without insurance or with private insurance. And that's not going to represent the entire cost of the risk transfer. Here's some numbers from the annual and perennial crop insurance program. So these are from 2024. Again, pretty fresh off of the press here. You can see how many acres are insured across annual and perennial, a few less than perennial. We've got roughly the same amount of acres, I think, that are eligible for each side. Annual is a little bit fewer. I think it's 21 million versus maybe 24 million for perennial, if you include hay and pasture and everything on that end, and native and tame pasture are included in that number because they're insurable. So we've got, disparity in the acres that are insured, as well as the number of farms, which is in that subscription count number. See annual having, a few more, 5,000 more farms involved with the insurance. And where it gets really interesting, I think, in terms of funding is this premium number. And this is total premium, but it represents, if you're multiplying it by 0.6 or 0.4 or whatever number, it's the same percentage. So that blue and red pie chart on the left is a breakdown of that number. Perennial is about 13% of the total value of premiums. So that's in the insurance programs, perennial represents about 13% of funding. And 87% of that goes to the annual side. So is that a problem? I think it is. And per acre, just to break it down to make it kind of real, I think is 42 versus $11 on the perennial side. Part of that is having to do with coverage. Coverage is much lower on the perennial side, as you can imagine, like a field of canola. Some of the crops that we're insuring in southern Alberta under irrigation are very high value, whereas you get into pasture land, especially native pasture. You look at Milk River where you're talking about acres per cow instead of cows per acre kind of frameworks. You got two skinny cows on a quarter section standing on a windy hill. The value of that stuff is quite low. So some of that effect is showing up in here too. Not overpowering though. I think in general, perennial products are underfunded. This is a look at the Canadian numbers. So across Canada, where's the BRM program dollars going? This is from 2023 and it's a forecast. So I just pulled this out of a deck that one of our policy guys had. Really good illustration though. It's roughly accurate. And it just shows, there's maybe a quarter of the funding going to livestock, and the cash receipts are showing a different story. So there's almost half of the Canadian cash receipts coming from livestock, and that includes, hog barns and things like that too. But in Alberta, it's not so different. I think on the insurance side, it's even more unequal. But why is there this big imbalance? One of the questions that we have to ask ourselves, I think, we've gone through a few sessions with national level industry groups and the other provinces trying to figure out why perennial participation is low. Why isn't it that producers are in these programs, and what's happening? Why are they funded at the level they are? Some of it's coverage, but some of it's participation rates. So the participation is about half, and 44% on the perennial side. This is compared to the eligible acres that we see from Stats Canada. It is the highest we've ever had it. Some changes we've made to these programs in the last few years, and communication and sales and marketing, God forbid, in a government subsidized monopoly, have increased that number quite a bit, gotten people into these programs. In the words of Alberta Beef, we want stable programming. We don't want agri recoveries. They don't really solve anything. But the stable programming is kind of what's the industry wants. So we're on that track. 44% is higher than anything else in Canada, other than Nova Scotia, I think, who talks to every single one of their livestock producers every 3 days, which is awesome. I wish we could do that in Alberta. And, we look across the border at Montana and we see programs that aren't as technically good that have 80% participation, or like a rainfall product in pasture. And they do very aggressive sales and marketing. There's commission involved. And the farms get, 4 or 5 visits every year from different sales reps on these products. So I think, we've got programs that are technically fairly good, but product relevance in perennial is a hard nut to crack. And you see that across Canada, where we can't measure grass. So you can't go out there and take a sample of it. You could clip it, I suppose, and we used to do that with our satellite program. Terribly inaccurate. The satellite program was canceled. The whole thing was quite inaccurate. And, it's usually in a cow. So you can't get at it. So you can weigh the cows in and out. The US is looking at wean weight programs, and I think they have one now. So we've done some work on looking at something like that. But we're still not getting at the revenue. So like you're insuring canola, once canola's in the bin, you take it to the elevator or deliver on a contract, you get a check. That canola is directly related to the revenue, and that's what's insured. But we're insuring grass in a lot of cases, or hay or something. So we're insuring feed, which isn't directly related to the revenue. It's an input into the actual commodity that's being produced. So I think there's something there. And then we've got culture of risk management. It's a little bit different. I think livestock folks, on average, we've seen in some of our Meetings, we conduct quite a few meetings with farms. We get 20 people in a room and ask them how they like the government and expect it to go well. And some of those are great. So we get lots of good information from people. And, we're hearing more price sensitivity to premiums on the livestock side. Maybe that's from less cash flow. Maybe it's a paradox. So whatever the reason, I think there's some things about holistic management too, where I think livestock producers in general are maybe a little bit less intense. We used to keep a year worth of bales in the yard, and they, half of them would rot, but they were there. It was a risk management tool. So we didn't need all that insurance. And some people, I think, don't need all the insurance, don't want all the insurance. A lot of designed things in there with the insurance products, I think that we can look at here in the next couple of years. And knowledge that products exist has to be there. So the product has to be good enough, and then people have to know it's there and what it can do for them. And sometimes that's, how much money are you taking out versus how much are you putting in? That can be a factor. So what's driving land use? This is my vain attempt to put some things down on paper on this regard so we can see it. So I think insurance is a thing. The differential between different commodities in terms of insurance and the levels of support that exist between the different commodities. Markets, I think, are huge. I'm not sure how big these are compared to each other. Like, I think input costs and output prices are two of the biggest drivers of profitability. I think profitability drives land use in general. Slow me down if I'm wrong here. But, how that land is, what that land is to begin with, what the topography is, which soil zone it's in, how much rain it gets. Huge indicators, I think, very highly correlated with what is grown there. But you look at the US-Canadian border, I think is interesting because we have native pasture down there a lot on our side. And then you step across the border and it's irrigated cropland. In Montana, it seems like there's a lot of cropland across the border. So what's happening there? What is driving that? And maybe there's things that we can learn from the American system. Skills, I think, are a thing, but how well somebody can do something. If you're trained to be a livestock producer and you've done it all your life, I don't know if you want to do canola, and vice versa. I hate cows, but that's for a few reasons. Mostly because I hate horses. Okay, so you peel away the insurance from the equation. This is some numbers from Stats Canada. I think the last census looks like 2020, but in terms of revenue and expenses here, it's showing beef, which is cattle and feedlots, I guess, are lumped in there. So feedlots could have an effect here. They're usually very tight margin, high volatility operations, which is why agri-stability works really well for them, kind of like hog operations. And oilseed and grain farming is the light bar. So revenue higher for the oilseed and grain farming, expenses lower. It's a very striking chart if it's correct. We take Stats Canada stuff sometimes. I think they get it right on average, and not sure if it's exactly correct in Alberta context or in a 2024, 2025 type context. I think cattle prices have been going up. So there's things going on in here. But in general, large argument to grow canola over cattle or grass. So I'm not sure how marginal land plays into this either, but kind of speculating that it might get tighter on marginal land, that you're, the difference between the two might close up a little bit, but you'd still get the opportunity with something like canola to pour the groceries on it and get a good yield, make a bunch of revenue. So I think lots of stuff happening in here. All right, so I'm droning on. I'm going to keep going. Power through here, guys. Where is AFSC with environmental incentivization? This is a question that doesn't come up a lot. Like, I've put this in here because it's what I've heard and what I've taken in indirectly, and are some of my thoughts, I guess. But it's not right in the front of anybody's mind. So we'll get into kind of the current stuff that we're doing here, but the big mantra, I think, in our context, in the context of cost shared insurance, which is a very hard thing to get out of, we're an institution. that goes back a long ways. Politically speaking, backing out of cost-shared insurance is a nightmare for any politician. Terrible thing. You can add stuff, but taking it away is a lot harder than adding it. Even taking away funding from current programs, even if they still exist, very difficult thing to do. So inside of this context, some general statements might be, I think the biggest one is that we don't want to tell someone how to farm, but we want to insure it accurately. This comes up with Club Root a lot. Now, it's always a neighbor's fault, number one, but somebody wants us to do something with it and police it and enforce it. We say, well, it's kind of Pandora's box. You open up that can and you have to go look at fungus and peas and different things and rotations and everything under the sun. So ensuring it accurately based on outcomes, and I think outcomes matter because they let someone get there in the best way for them. So if we can find what outcomes come out of those things and ensure that accurately, I think that's kind of where we're at. We really think there is a strong feeling we're not the police of some of these practices in agriculture, like crop rotations. Great example. I think the thinking right now, especially, is that equity across sectors matter. Some of that's being driven by industry, some of that's being driven by us. However we got here in terms of funding allocations, that removing that incentive, kind of creating equity across the range so that the same level of support is there for both sectors is important. And that the link between that risk and conservation matters. We care about risk more than anything else, I think. So if something's linked to risk, we care about it quite a bit. Some recent work around soil driving risk factors has been done. I think we did that with Sericon, and great work that Saskatchewan's done a bit of as well and is rolling into a BMP pilot as part of the SCAP, but showing that soil organic matter is driving reductions in risk and increases in yield. So it might not be a surprise to anybody on the call. And we're very supportive of federal initiatives. We have a great working relationship. I think at our level, the bureaucratic level, the politicians yell at each other sometimes, but it's very good. At our level, I don't think it's been better than it is right now. So we're involved in a lot of stuff. We provide in-kind support. If they want to look at impacts of climate change, stuff like that, they have data. That's ours. I think they have that anyway, but we're right in there working on it too most of the time. So we talked about the last funding agreement. I'm just throwing in the outcome statements here in 5.3, and this was the first agreement that we've seen environmental policy included in as a requirement. So, this outcome, the first outcome here, improved sector environmental performance, adaptation to climate change, and reduction of greenhouse gas emissions. A lot of stuff going on in there that's outside of crop insurance, but it's there now, and I don't think we'll see less of it depending on the type of government we get in the next election. So the things that were added in this go around, we have a requirement. Every province has a requirement to create or pick a best management practice that both reduces risk and has an environmental outcome, and provide a discount or some type of premium rating differential or something where somebody would see lower premiums for engaging in that practice that reduces risk. So our version is going to be soil organic carbon related, and we've got a low impact to producers way to look at soil carbon. There's a model that looks really great. Some of you may know the people involved with that. I don't know if I can say it or not, but anyway, so we're looking at that. I'm going to see what happens there and see if we can at some point. I think the end goal is to look at premium rating models and whether we can introduce those types of attributes into them and make insurance more accurate. So at the same time as we're insuring more accurately at the farm level based on attributes that affect risk, potential to have environmental outcomes at the same time, or create incentives that make sense or are natural and don't skew things as much as possible. Wanted to throw in climate change in here just to talk about it. This doesn't come up a whole lot. We're working with the feds on a scenario analysis kind of project to look at what happens if climate change happens, if temperatures rise. They have access to all the Alberta data on climate too. That weather network in Alberta is so good. Ralph and his team, Jan and May and Pavel and sorts have created a network that's 200 stations strong, just our stations, and we use that for crop insurance, and they use it for a number of things, but it's one of the best in the world, I think. So, what happens with climate change? I have no idea. I don't think we're not really 100% sure on anything here. We have no clue. Are we going to get more corn and soybeans like Iowa, maybe? Is it an opportunity in some areas? Are we getting more volatile climate happening? We haven't seen more hail in the last 5 years. We've actually seen less hail than we ever have, probably because it's been dry. So is the drought due to climate change? Is the heat? Depends on who you talk to, I think. But I think if a C wants to know what's going to happen very much, but doesn't want to be involved in the political side of that one. Maybe. It's pretty charged. So we're really interested in what's going to happen to risk. And where are we headed? All right. So, I think a lot of this stuff is pretty recent. Our existing current systems, they capture outcomes through mechanisms like individual yield coverage and uninsurable causes of loss. If we can, if there's something that somebody does that doesn't make sense, that causes a loss that's really bad, like grows canola 5 years in a row, that type of thing. And premium surcharge discounts based on how much premium is going in versus how much indemnity is coming out, kind of individualizes some of that insurance premium. So there's some of that intrinsically catches things already, but I think where we're headed, or where we want to head, is where a lot of insurance companies are headed. Like car companies, you see those GPSs in cars. And if you drive not like an insane man like John here, then you get a discount on your insurance. And I think that's kind of where we want to go, is that we don't want to charge the whole pool for the sins of some folks. And we want people who are doing the right thing, or low risk folks, to get the correct premium. And we did kind of the same thing when individual coverage came in, where so there was winners and losers on that one, but no argument from anybody, I think, because it was exactly what was being produced is what we were covering. So the same thing on the premium rating side. I think we'd like to go in that direction. Really like to let farms to choose the path that they want to get there to those outcomes, and leave the policing up to somebody else. That might be a cop-out, but it's exactly where I think we should be, in my opinion. Saying things here that hoping to spur the discussion later. And really focus right now on the livestock sector. So how do we get the participation up in the context that we have there? The reasons why the participation is lower and the coverage might be lower. How do we make that equitable and not provide some type of market distortion there because of that funding inequity? Just to make sure that if people are making that choice, they're not making it because of us. I think that's a thing. So does insurance influence land use? Yeah, I think for sure it does, especially in marginal cases, I think, or cases where it really makes sense for somebody and on the economic side, and we are part of that economic equation, absolutely. How large is that effect? We haven't done a whole lot of work to figure that out. Like we haven't looked at where we're at, where the tipping points are, what the scenarios are, which scenarios do we do this in, or is it even a real thing? How is it significant enough to care about? Any of those types of questions haven't been answered. And I think a lot of the time higher cattle prices and lower canola prices would solve land use issues. So there's a whole bunch of stuff in this mix, I think.
Sure.
But that's all I have here for sitting here and ranting. But
no, this is Thank you, Jesse. That was great. A really good presentation. And I often think, Jesse and I were in grad school together too, Central Alberta farm boys, and we kind of each went one way a little bit. I went more some of the environmental economics route, and Jesse really dove into a lot of this area, and I appreciate hearing some of the work you've been doing since then, and even those hard discussions we always sort of had. So I see there's some good questions here. If you want to, okay, we got lots, and we only have a few minutes to chat, so make sure we'll try to be brief with your responses, Jesse.
Sorry, I talk a lot.
No. So we have Susie Miller has her hand up. We'll maybe go first to Susie, and then we have Ron and Craig and Glenn and others. So.
Okay, I'm Susie Miller from the Canadian Roundtable for Sustainable Crops. And you talk about land change in the context of wholesale land change. But a lot of the conservation issues are partial, whether it's draining wetland, removing bush and other material around the peripheries, etc. Are you doing any work looking at that context and how it impacts the risk profile of a farmer, of a client?
Yeah, no, not at all. Good question though. Like, for instance, how a wetland would soak up water in a drought, maybe release it a little bit better, prevent flooding, that type of stuff. Reducing the risk reduction elements of something like that, or forested areas, or whatever is being taken out for farming purposes. You see the brush piles everywhere. Well, not everywhere. Some places.
The reason I'm asking is because we had a literature review done by the University of Alberta in 2019 that looked at the on-farm benefits of retaining biodiversity, and we could find absolutely no studies of relevance to this. But this is where crop producers are being pushed a bit in terms of the retention of the grasslands, the trees, the etc. Not wholesale conversion, but land management quote improvements.
Yeah, it's a good question, like the drainage and etc. So I think like insurance definitely factors into that. Like the equation is different. The economic equation is different for that land that's being farmed versus what's being taken out to farm over or whatever is happening. I think the work on that is necessary. I think not a whole lot of work being done to drive policy there. So like, what does insurance do in those cases? How is it affecting that? Might be good information to feed into the process, because there's really no policy about environmental benefits or negative effects of crop insurance. Like there's nothing being driven by that right now. It's centered around financial sustainability. And to be honest, some politics. A lot of politics.
Thanks.
Yeah.
Thanks.
Great. Thanks, Susie, and thanks, Jesse. Jumping sort of backwards, Craig Harding has a question. Do you want to speak to it, Craig, or do you want to keep it in the chat?
Sure, I can speak. I'll just make it quick. I was just curious, Jesse, if there's been any sort of work on sort of how you'd account for the example you used was soil organic carbon as part of sort of the insurance premium part of the equation.
Yeah, I like that question because I can answer it. That's great. The like how we're currently looking at that and how that study was done. And I'm not to the other question here. I'm not sure if we can get that out the door, but if we can, I will. I'll look into that and send it to you, John, if we can get you that study that Sarah Kahn did, because it's really interesting actually. So we basically took data that we have on losses and premiums, and that's what we use for risk. It's a proxy for risk, but it's a pretty good proxy. Like the loss to premium ratio just indicates how risky someone is, especially compared to somebody else or some other piece of land or something. So how much is being taken off versus how much is being put in is a great indicator of how risky something is in our world. So we took that and basically modeled it against soil organic carbon, and that carbon number or metric was from a data set that was from, I think it's Kim Cornish and maybe from the University of Saskatchewan. We have a bit of a partnership with her in terms of using that data or looking at it, trying to support their work, and thinking that something like that would be very useful for us in the future to put into premium rating models. So basically, what is the relationship between, trying to draw a causal relationship between the soil organic carbon and that's modeled, and it's at less than the field level. Like there's multiple polygons in the fields, and I think it's, they've done a lot of work to ground truth it with soil tests down to a meter in different scenarios. Soil organic carbon can be a very elusive thing because different parts of a field can be quite a bit different, but it's granular enough that we think it's pretty useful for something like this. And so basically looking at what effect does it have on loss to premium ratios, and that drives premium rating. That's directly related to what somebody would be charged.
Okay, thanks, Jesse, for that response. And if Craig, if you want to follow up more with Jesse on any of that, reach out to me. Just want to touch on the Brian Ely's question about any work calculating the amount of government support on an acre of marginal land versus an acre, versus cropland versus marginal cattle. You can read it.
Yeah, no, it's a good question. We're not too concerned about it. Like we haven't looked at it. I don't think, probably because we haven't thought of a reason to yet. So if the reason is, what is the effect of crop insurance on that marginal land, and what's the level of support there in comparison, I think that's a pretty good reason. So I think we have all the data there by land location, basically, on our end. Some of that data is hard to get out the door if it's going to be done externally, but internally speaking, we have all that data and could look at that if we knew what marginal land was. So if we had a data set that said, okay, this is all what we would consider marginal land, and I'm not sure what the metrics would be there, have to peg that somehow. We could separate it into categories, maybe buckets based on productive capacity, or what it was 20 years ago, maybe versus now. I think there's some differences now. I see canola farther and farther west from Lacombe, which gets into higher elevations and more pasture type land that's good for cattle. So, we see it for sure, but we haven't done any of that yet.
Perfect. Okay. Thank you. Maybe we'll squeeze one more in. Sam Robinson, do you have your hand up? And also just to mention, Glenn Friesen wants to know about funding that SOC model, that you'll flag that for after if you want, Jesse.
Oh yeah, sure. That sounds good.
Yeah.
Hey Sam, thanks, any relation to Frank?
No, there's lots of us Robinsons around though, so maybe somewhere back
Awesome.
in the family tree, but no. Yes, I work for Ducks Unlimited, and I was wondering how you calculate this sort of goes to your last point about marginality, but how are you calculating marginality? So is it sort of on a quarter section basis, or are you looking at sort of divisions within that?
Yeah, so basically, like, we don't call anything marginal or not, have no classifications on what marginality is. I think, like, the way our system generally works is through risk area pooling. So we have geographic pooling, where we take an area, theoretically the area that we pick, like a county, or they're usually bigger than a county, so they include a number of counties, is supposed to include similar land. And within that risk pool, some of them don't, some of them are all over the place, but theoretically similar. So within that risk pool, you get the same, or similar premium rates and similar startup coverage and stuff for insurance. And that's the pool that is used to protect, like, somebody in that pool would protect somebody else in the same pool. There's also, Alberta effects. So the insurance system, I think, is so much different in a lot of respects to how somebody would look at that in terms of land use or conservation or anything else. So, like, in our minds, like, we really want to group the risk well and figure out where that is and charge somebody the right premium. The topic of land use and conservation doesn't come up a whole lot outside of the conversation involving market distortion. So we're not at all categorizing anything as marginal or good land or bad land. We do have more continuous numbers on yields and performance in terms of risk. So like that loss of yield number would be an interesting one to look at in terms of marginality as well.
Interesting.
But,
okay. Well, maybe I'll hit you up afterwards and we can have a discussion about this. But yeah,
I think
curious to talk about that.
There's in this room, there's a ton of potential for collaboration with insurance, whatever province you're in too. Like every province has their own data sets and they're slightly different, but across Western Canada, not too hard, take some groundwork and some politicking, but you can get data sets across Western Canada potentially on some of these things. If you have data on other things, like if you had data on what marginal land was or what attributes you were looking for, we might have something that matched that could be put into a study or something. Because I think that stuff like driving policy is missing. It's not totally there. The stuff that's driving policy now is things like federal lobbying and incentives there on the environmental side. And I'm scared of that. Like, to be honest, some of these things coming in are driven, like for instance, I think there was a group that was primarily focused on organic production, lobbying for greenhouse gas reduction via fertilizer use. They don't use fertilizer in the organic side, like that type of fertilizer anyway. So it's very, very interesting where some of these things come from, and we'd like to see it make a lot of sense.
Sure. Well, thanks, Jesse, and thanks everyone. I think what strikes me too is this sort of we can always get in sort of our own communities and silos, and to hear even what you're saying, Jesse, that it's these questions around conservation don't come up that much in the insurance side. I mean, that's striking sort of a dissonance between some of the other communities that that are represented here in this group, and so that collaboration and communication is important. So
I mean, I hear about climate change from the reporters once a week. They're always asking about that.
Right.
And so the reply to that is just no. Like we're not answering anything about climate change. We'll tell you what the impact might be at some point, but
yeah,
it's just a
thank you so much. Yeah. So thanks so much for your time, Jesse. Thanks everyone for joining. And if anyone has questions, reach out to me and I can connect you with Jesse and we can carry on this conversation. So also, there will be no webinar in December. I can hear the cries of lament all around, but getting close to Christmas, we'll restart again in January. So thanks, everyone. Great to see you all. Thanks, Ian. Thanks, Jesse.
I'll throw my email in the chat here, too.
Yeah. Great idea.
Awesome.
All right.
Thanks, folks.
And this will be posted up on the YouTube channel of PHJV as well, probably by this afternoon. Okay. Have a great day, everyone.
Bye. See ya.